market movers. This is The Pulse with Francine Lacqua.
Well, good morning and welcome to The Pulse. I'm Francine Lacqua here in London. Now, the global slump in tech stocks pauses as traders weigh whether the sell-off had gone a little bit too far. Now, the initial rout in software companies extended across the sector, including chip makers. Over the last 2 days, hundreds of billions of dollars have been wiped off the value of companies, well, stocks, corporate bonds, but also loans. So we're joined by our Bloomberg senior strategist, Neil Camping. Neil, again, the nature of the sell-off is actually quite different. Will it spread further? This is about business models, not necessarily valuations.
I think investors are now making the right question, which is who owns the data? And so within AI, there are different models where some own the data, like Google's Gemini, and some don't, like Microsoft with OpenAI. But now it's spreading into other businesses that are probably, at threat because they don't own the data. They may be aggregators or data processors. And that, I think, is where the concern has been coming through during this week when you've seen new AI tools being released that's called into question many of those aspects as to how, as investors, do we apply the terminal value of some of these business models? And that's what's been coming under question and under pressure this week.
So, Neil, do you expect this to still spread?
Yes, I think that is certainly the case. We may have a respite in the short term because some things are very, very oversold on technical factors. But I do think that what happens in most technology cycles is there's a very small handful of winners. And so as that spreads and people start to apply where they think the winners and losers are, then definitely there are a lot of stocks that have risen substantially on the promises and hopes of AI. But actually, the economic value will be probably very restricted to a very few handful of winners. And so, yes, I do think it will spread.
Neil, mixed results from Alphabet, Arm, and Qualcomm. So what are the big takeaways for investors?
But the big takeaways are, for one, again, AI is having a massive impact because it's creating memory shortages. These big compute models need a lot of memory, and so there's less left over for high-intensive consumer applications like smartphones and laptops. And we're hearing that message really come through in Qualcomm and in Arm. In contrast to that, what we saw, I think, within the results from Alphabet last night was actually a massive increase in CapEx spend, obviously. Now, they're justifying that because they have a 15-fold increase in customer engagements on AI. And if you look at their CapEx spend, the three companies that have reported so far of the hyperscalers, Meta and Microsoft and Alphabet, are talking now about over $400 billion of CapEx in 2026 spending combined. That's a 5-fold increase from where we were just 3 years ago. And there are winners from that benefit as well, because as that CapEx is deployed, there is a substantial amount of compute that other component companies will succeed on, especially in that Alphabet Gemini AI system.
Neil, thank you so much. Of course, that was a full roundup of everything that we've seen. Also, the NVIDIA CEO saying that software sell-off is the most illogical thing in the world. That was our Bloomberg senior strategist, Neil Campling. Now, the Bank of England widely expected to leave interest rates on hold later today, despite mounting concerns about the UK labour market. The central bank is expected to wait for more evidence that inflation is under control. With us now, Iain Stealey, International Chief Investment Officer for Fixed Income at JPMorgan Asset Management, and Bruna, Skarica, Chief UK Economist at Morgan Stanley. So thank you both for joining us. I mean, we have to start with AI. I know we're going to go on to central banks. But, I mean, your thoughts, again, some of these are correlated in terms of corporate bonds and things like that. Is it being sold off? Is it the realization that business models were changed? Like, what are we living through?
So I think actually what Neil said was completely right. What we've had is effectively AI jitters. We've had it for a while. Valuations are obviously very elevated, and there's big question marks around what the future holds, where's the revenue going to be generated, which companies are going to be the winners, which companies are going to be the losers. It does feel, at least the last couple of days, has been quite indiscriminate, sort of sell first and ask questions later. So there's probably is a lot of value to be had if you can get the right names. I think it's a great environment for good stock pickers who understand the kind of the bottom-ups of these companies, what they're doing. And he's absolutely right. There are some companies that ultimately will be impacted by this, whereas others will be benefits. You know, people will be able to use AI to improve efficiencies. There will still be the companies that have their own sort of data warehouses, that's their own proprietary information. AI can't get hold of that in theory. So I think it's a very interesting environment. It reminds me, you know, we've had a few of these over the last year. I remember it was only a year ago we had DeepSeek and everyone suddenly panicked, and then everything came back. But I feel there's going to be a lot of opportunities coming out of this.
We'll talk about central banks, but Bruna, does this change actually the fabric of economies? It's unclear, and we need to talk about UK political risk. There's a lot going on in the UK right now. But actually, how does the UK economy change under AI?
Yeah, I mean, one thing that has been really interesting in UK is that we've had this ongoing decline in payrolls. I think for 18 months straight, HMRC payrolls have been negative. Over that period, actually, the economy has grown. This was not spectacular growth, but it was growth nonetheless. So about 1% decline in payrolls, about 1.5% growth. When you combine those two things, there is a bit of a cyclical productivity growth upswing. Now, how much of that is just cyclical? There's a little bit of reversal of labour shedding going on. Businesses are obviously dealing with steep labour costs. And how much of it is actual structural productivity improvement, perhaps due to investment in AI? We'll actually find out probably over the course of this year. If activity continues to improve, but hiring is sluggish, then maybe we do live in a world where businesses are becoming a little bit more capital intense. And I would expect actually the BOE to comment on this at the meeting today. Yeah,
I'm sure he'll also otherwise get pounded in the press conference, which many of us will be attending. What are you expecting from the Bank of England right now?
I can't be too excited, can I?
I mean, it's quite exciting.
It's more going. I guess they're not going to do anything. But to me, it's more around firstly the voter split. How many dissenters do we get? Obviously, December was a very close call. We had Governor Bailey effectively making that kind of final decision. So do we get any excitement there? And then really it's going to be around the forward guidelines, guidance. What do they kind of, if anything, that they think they're going to happen? I mean, our base case is that actually what the market's pricing is probably undershoots what could happen if we do get the inflation coming down as expected in the second quarter. We're starting to, as you mentioned, we're starting to see weakness weakness continues in the labour market, at least from sort of job growth. I think this is an environment where the Bank of England could do a little bit more, but they do need to see inflation come down.
Iain, I know one thing that they don't want to talk about will be the political risk, but actually the chances of Keir Starmer leaving is now starting to be priced in at the margins in the market. So how does the Bank of England deal with that?
I think the Bank of England should continue to do what it always does, which is focus on the economy. Obviously, there will be concerns around more the long end of the gilt market. We're seeing the curve steepen up to levels that we haven't seen for a number of years. At the moment, the front end should still focus on what they're planning and what they're thinking about. And that's actually where I've got more conviction in, because I do think you're playing economics in the front end, and maybe politics might have more of an impact towards the longer end.
Bruna, agreed?
I agree. I do think we need to keep in mind that monetary policy does not operate in a vacuum. It operates in conversation with fiscal policy. So if you're a policymaker, you're always thinking about what's next in terms of the fiscal outlook. But yeah, absolutely. In the very near term, it's all about that inflation coming down and the labour market. Yeah.
But how does this economy grow? I mean, the million-dollar question is actually what's the real growth plan going forward?
I mean, I thought the two data points we got at the end of the year, so the November GDP and the PMIs, were quite interesting. Because there is a bit of a focus, especially in the PMI write-up, on the finance sector and the tech sector. So I do think there's something to be said about kind of externally oriented sectors, perhaps picking up steam a little bit faster than consumer-facing sectors. And while we're all focused on the UK consumer, it is the 2/3 of the UK economy is domestic expenditure, private domestic expenditure. Look, these white-collar services sectors are the backbone of the UK economy, and if global growth is accelerating, it is a tide that lifts all boats. And I think the answer to your question is that's really where the growth comes in this year, I would say, in the UK as well.
Yeah, I mean, given all of the kind of, geopolitics has our hearts racing, there's all this like tech. Even if you look at the ECB, I mean, they're pretty much in line with expectations. We're not expecting anything huge. I mean, is the next big question whether we are going to see a hike as the next move?
So I would take the opposite side of that, and I think actually if you think about what happens with the inflation numbers, what's going to happen with inflation in Europe over the next few months or so, it's going to probably undershoot their targets, and they are a single mandate central bank. It is all about price stability. And I think if you do get inflation coming down a little bit faster, or a little bit more, I should say, than maybe their forecasts are showing, there's going to be some doves on the council that are suddenly starting to ask the question, have we done enough? Against that, obviously, we know there's German fiscal spending coming. We know that we should be getting growth supportive measures out of Europe, but I do think it's going to be, in the near term, it's going to be inflation. So if I look at the pricing today, I actually think it's pretty asymmetric. My base case is they stay on hold, but I just don't see an environment where, at least for the rest of this year, they're talking about hiking rates. But if inflation does undershoot, then we could be back in the rate cut discussion.
What are the dynamics with China? Because are we kind of importing deflation from China?
Well, I think there's a few different dynamics, isn't there? Because you've got commodity prices. Obviously, they've jumped recently, but generally commodity prices. You've got the stronger euro over the last 12 months or so. You have got that question mark: where are China going to import all the goods that the US is no longer taking as much? What that should come to Europe. So there are this sort of disinflationary measures that are coming into Europe, and again, I think that's going to weigh on what is already a level that's expected to be below target over the next couple of months.
Yeah, I also want to correct myself, because we had quite a lot of geopolitics in terms of trade and tariffs and tension, probably stressing out a lot of the central banks. Bruna, I mean, the dynamics for the UK are different to Europe, but we're also, on the inflation point from China, could be similar dynamics.
Yeah, I expect trade diversion to feature very heavily today. The Bank of England had an interesting piece of research that they published, I think it was a couple of weeks ago, where they actually said some of these export prices from China in the aftermath of Liberation Day had picked up. So they're taking a slightly opposite view, but I do think the headline conclusion would be, over the longer run, trade diversion could certainly be a disinflationary factor for UK as well. I mean, UK, I would say, we import everything we consume. We import our food from Europe, and we import our goods from Southeast Asia. About 25% of consumer goods that we consume in the UK, we import from China and Southeast Asia. So it really does matter a lot for the UK as well.
And I know the UK, and actually Governor Bailey specifically, never wants to talk about what the Fed does, and but they're correlated. I mean, what does the appointment of Kevin Warsh mean for what the influence of the Fed could have on the Bank of England?
I mean, I think in terms of the Bank of England never wants to talk about what the Fed does. I think they talk and think about the U.S. economy, right, and the impact it has on the UK, right? So they will think about a potential uptick in U.S. growth over the course of this year. They'll think about the dollar as well. Again, the FX pass-through coefficient in the UK is far bigger than it is in the euro area. So the move in sterling actually could be a bit more consequential than in the euro area as well. So these are factors that I think they'll talk about, even if they're not talking directly about perhaps the appointment itself and obviously the internal politics of the Fed. Yeah.
And what do you like in fixed income right now?
I think it's still a carry environment. Okay. I think we're in an environment where actually rate volatility has been very low. So for all the excitement that we're seeing in software and everything else, rates they've drifted a little bit higher over the course of the year, but rate vol is still low. I don't see central banks tightening policy outside of Australia over the next few months or so. So if you're in an environment where global growth looks like should be on a bit of an upswing, given some of the tailwinds that are happening, corporate credit should be great. You should be able to continue to grab that additional yield. So really, it's just kind of finding the good spots to earn the carry. And then I do think there's a really kind of interesting environment in some of the local emerging markets where the story is very, very positive. And actually, the investor base seems to be kind of picking up on that. If you look at the flows year to date, from our own fund trackers that we do internally, it's about a third of what was put into emerging market local and mutual funds last year has already gone in this year. So it really is sort of the hot place that people are looking for investment, and there's still some value to be had.
Treasuries? I
think we're in a range. I think we're sort of we're getting actually probably closer to the upper end of that range where you want to be looking at opportunities to buy.
Okay, thank you both for joining us, getting us started on a big day for central banks. Iain Stealey from JPMorgan Asset Management and Morgan Stanley's Bruna, Skarica. Now, coming up, President Trump says Iran should be very worried as the U.S. bolsters its military presence in the Middle East. We'll look at tomorrow's talks between the U.S. and Iran next. This is Bloomberg.
The Bank of England makes its next interest rate decision. As inflation rises and the labor market cools, investors will be looking for clues from Governor Andrew Bailey on the pace of rate cuts for the year ahead.
With every cut in bank rates, how much further to go becomes a closer call.
Tune into Bloomberg for live coverage of the BOE decision and press conference. It all starts today at 12:30 p.m. on Bloomberg. Context changes everything.
The conversations that matter, the insights you need. This is The Pulse, and I'm Francine Lacqua here in London. Now, the U.S. president has said Iran should be very worried as America bolsters its military presence in the Middle East. Donald Trump was speaking to NBC as the U.S. and Iran confirmed that diplomatic talks will take place in Amman tomorrow.
I would say he should be very worried, yeah, he should be. As you know, they're negotiating with us.
I know they are, but the protesters have said, you know, where are the Americans? You promised them we would have their back. Do we still have their back?
Well, we've had their back, and look, that country's a mess right now because of us. We went in, we wiped out their nuclear.
So that's the question. If we wipe them out,
we have peace in the Middle East.
Yeah.
If I didn't take out their nuclear, think of it. If we didn't take out that nuclear, we wouldn't have peace in the Middle East because the Arab countries could have never done that. They were very, very afraid of Iran.
Yeah.
They're not afraid of Iran anymore.
Well, let's bring in Ellie Geranmayeh, Deputy Director of the Middle East and North Africa Program at the European Council on Foreign Relations. Thank you so much for joining us. Ellie, what do you think the way forward is? We're all waiting for something to happen in Iran, but it's unclear what the U.S. president has in mind.
Well, good morning. Thanks for having me on the show. I think for both Washington and Tehran, we are really reaching a crunch point for decision making. Either it's going to be a military conflict that we're entering into after these talks in Oman, or that in Oman there are some serious steps made on both the technical and political sides to pave open a serious and genuine political track. And so I think right now, both the leadership in Iran and President Trump will have to face the music and see whether they go for the war option or for the peace option. I don't think it's any longer viable to have the no war, no peace status quo that we've had since June and prior to that also. So it's decision time for both sides. But having said that, from everything that we are seeing and hearing, the two sides still remain very far apart regarding the scope of potential negotiations. And even, for example, the format. It's clear that the president and President Trump prefers very direct negotiations to fast-track a process. On the Iranian side, there is still too much distrust after the U.S. bombed Iran in ongoing negotiations in June. And so they want to try and do this through an indirect intermediary, which will, of course, slow the process down.
Where do you see, I mean, if Iran, what does President Trump want from Iran today, Ellie?
Well, look, the end game is very unclear, frankly. We go from one day this being about not giving Iran nuclear weapons, when the president himself, since the June bombings against Iranian nuclear sites by the U.S., said that Iran's nuclear program is over, is obliterated. But now we're hearing again that the president is still focused on the nuclear issue. Then you have the Secretary of State, Marco Rubio, talking about denying Iran's missile capabilities, addressing its regional activities, and also its human rights conditions on the ground. So that introduces a whole other series of issues into the negotiations. It's clear from the Iranian side, the only thing that they are wanting to discuss with the Americans is restricted to the nuclear issue, but they have signaled openness to discuss regional issues with regional players, so Saudi Arabia, Qatar, Emirates, Pakistan, Turkey. So that may be the result of a two-track process that we end up having, one on the regional issues and one on the nuclear issues focused on the U.S. But frankly, it has been a lot of mixed messages from Washington with respect to what the end game is. And some might even say it may be regime change and that this military buildup that we have seen is not necessarily for strengthening the U.S. position in negotiations, but it's basically once negotiations fail because of these maximalist demands from the U.S. that they basically order the strikes in Iran. But to what end, we're not sure.
If you look at some of the contrasting positions over just the parameters of the talks tomorrow, are you hopeful that something will be achieved, or are they just too far apart for any major differences to be bridged?
Look, I think if you're in the business of diplomacy and conflict resolution, you always have to have a degree of hope that a breakthrough could be made. Right now, however, I think there is quite low confidence that that breakthrough can be achieved. But Iran is constantly surprising itself in the world. The US president is constantly surprising the US system in the world. So it's not an impossibility, but right now it does seem that the two sides are frankly too far apart. They are also both sticking to this position of maximum pressure from the US side and a show of real willingness to use force again inside Iran with the type of military buildup that we've seen. And Iran is still sticking to maximum resistance. And this time they are saying they will not be surprised like the June strikes that Israel and the US conducted, and that they will regionalize this war so that it won't be restricted to just Israel or the US, but it may affect the Strait of Hormuz. It may affect all installations across the region, for example, if they want to rattle markets around the world to make this painful for the US markets as well. So I think if there is an escalation, unless it is choreographed and managed and both sides remain restrained, there's a lot of room for escalation, for miscalculation, given the amount of US military buildup now very close to Iranian shores. And we may be in for a very, very messy conflict ahead.
Ellie, when you look at China, I mean, China has a huge role to play in this. Do we know what they're thinking when it comes to Iran? I think the U.S. also reached out to try and press China and others to break from Tehran.
So China, I think, has been its classic position of pretty quiet publicly, calling for de-escalation, not wanting a conflict. Behind the scenes, however, it has in the past tried to push for de-escalation, whether it's between Iran and Saudi Arabia several years ago, and to some extent between Iran and the US, because remember, if the energy markets in this part of the world are rattled, China is the first one to be harmed by this. But we have not seen any indication that China has peeled off Iran. If anything, the sort of teapot refineries that have been taking Iranian oil to Chinese refineries in circumvention of US sanctions have continued. We have seen reports that China, following the June strikes, has helped Iran restock its missile capabilities. And so this doesn't suggest that major fissures has been achieved between Beijing and Tehran.
Ellie, thanks so much. Ellie Geranmayeh there from the European Council on Foreign Relations. Coming up, earnings at BNP Paribas come in higher than expected. The bank tells Bloomberg that AI is helping to cut costs. So we'll have all of the details next. And this is Bloomberg. Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. The global tech sell-off deepens with $1 trillion wiped off the value of software stocks in 7 days. Tepid earnings from Alphabet, Qualcomm, and ARM hit sentiment further. BNP Paribas reports better than expected fourth quarter profit. Shell misses as lower crude prices dent earnings. Plus, the Bank of England and European Central Bank both expected to hold rates will set you for a double decision day. So let's get straight to that story from Frankfurt and the ECB. Bloomberg's Lizzie Burden is there for us. So, Lizzie, if you look at the decision, we're not expecting much today, but it's really their future expectation on inflation, if it's too low, that traders will be looking for.
Exactly, Francine. The latest growth numbers kind of give the Governing Council cover to stand pat today. But as they've been saying, they're in a good place. That's their conclusion at the moment. The expectation being that they don't move this year or next. But when it comes to today's commentary, as you emphasise, remember, not so long ago, at the end of last year, there was all of this hawkish talk started by the commentary from Isabel Schnabel. You saw it in the market reaction. That's been pared back somewhat because of three things. First of all, we've seen inflation inflation undershooting the target. Second, we've seen euro strength past, well, to the 120 level briefly last week, and Luis de Guindos, the Vice President, saying that that's the level that complicates matters for the ECB. Those comments last July. And then the Bank of France Governor François Villeroy de Gallo saying that they are going to be looking at currency moves as a factor in monetary policy because, of course, the worry is that it could damp exports and make that inflation undershoot more persistent. The third thing is the geopolitics, of course, and we've had President Trump's threats of tariffs on the nations opposed to his Greenland plans. Yes, they've been walked back, but the trade uncertainty lingers over the euro area economy. So all three are downside risks. I wouldn't expect President Lagarde to go back to this hawkish rhetoric that we heard from Schnabel. I was speaking to Martin Kocher, the Austrian central bank chief, and he was talking about the need to retain full optionality so that they can be ready to act if necessary. I'd expect Madame Lagarde to echo that and to talk again about a need for a data-dependent meeting-by-meeting approach.
Lizzie, thank you so much. Lizzie Burden there in Frankfurt. I think that's exactly also what François Villeroy de Gallo, the Banque de France, was saying in Davos. Now, BNP Paribas has raised some targets after reporting fourth quarter earnings that beat expectations. It's a boost for the chief executive and his plan to prop up the lender that has long lagged peers. Now, the bank's chief financial officer told Bloomberg that AI is helping to cut costs.
We will use natural attrition to get to optimized levels. So yes, maybe the overall staffing requirement will be less. We will get there through natural attrition. But then if we look at the overall economy, those jobs will be redeployed in other activities because the AI will also generate totally new activities. I mean, let's go back. It's what the internet did. It's whatever, all of these things that we've seen, it leads to a change in kind of activities. And that is what we anticipate.
Now I'm joined by Philip Richards, Senior Banks Analyst for Bloomberg Intelligence. Thank you for joining us. So BNP Paribas shares jumped at the open. Can the bank actually achieve its ambitious goals?
Yeah, good morning. Well, they're a challenge, I think it's fair to say. I mean, analyst estimates not even as high now as the old targets. So they're given a hike them as well. They have set the agenda quite challenging. Where's that extra upside going to come from? We know the French economy, yes, they passed the budget, but there's still quite slow growth. The investment bank, they did okay today, but they're still somewhat below what the US banks have been doing. So yes, it's good today, no doubt, but yes, some challenging targets ahead.
Meanwhile, BBVA met estimates. Has their growth since the failed Sabadell bid actually come to a close?
Well, in this quarter, we've seen that actually the growth held up quite well. They actually beat analyst estimates on the revenue side. However, the problem comes through on the cost side where they came in worse, and cost of risk was also worse as well. And that's why they missed at the bottom line. And that's what the shares are reacting to today. So, no, on the revenue side, yes, it's holding up. But yes, their challenges are definitely there as well.
All right, Philip, thanks so much. Philip Richards, our Senior Banks Analyst for Bloomberg Intelligence. Now, for more on the banking space, we're now joined by Jackie Ineke, Chief Investment Officer of Spring Investments. Jackie, so good to speak to you. I mean, there's been quite a lot of bank earnings in general, so it's certainly not dull. I mean, is there, of course, it depends on whether you're more into lending or more retail or more investment bank, if there's such thing in Europe. But what's your take so far of earnings?
I think it's been a great set of earnings. It typically always has been for quite a number of quarters now. But we look at the credit side of things. We focus on bank debt, AT1s. So from that perspective, the earnings have been super. You've seen, I think the standout for me has been the talk about ROEs, particularly in the next couple of years, reaching above 20% for a number of banks, like Caixa, Intesa, Santander. So super in terms of profitability, boring in terms of asset quality. There's nothing terrible coming out anywhere. Yeah. So the banks are still extremely strong quality. That seems to continue. We expect that for 2026 as well.
I mean, is there going to be a game changer at some point? I don't know whether you're expecting a big piece of M&A or a banking union to give it a kind of catalyst. Because you're right, it's fine.
Yeah. It's
just nothing huge, and the US ones could do much better in the future.
Yeah, I guess so. I think if you look at European banks versus how they were 5 years ago, it's amazing where they are now, to be fair. But in terms of game changer, yeah, we think there's going to be a lot of M&A over the next few years. The issue is it's going to be the larger banks buying the smaller banks. So in the big cap banks, there's not going to be a lot going on. But if you're investing in the smaller banks, in the smaller bank bonds that we have a lot in the portfolio, this is where you're going to get the real uplift. Mm-hmm. Yeah.
when you look at, I mean, Santander took a lot of people by surprise with the acquisition of the bank in the US for over $12 billion.
Yeah.
Is it a kind of template of things to come for Europe just because the US is more profitable?
I'm not sure. I mean, they're going for critical mass there. I mean, that acquisition makes a lot of sense. It looks quite expensive at 2 times book, but you know, that deposit base, it just makes sense for the business. I think in Europe, I don't think you're going to see those big cross-border acquisitions. I mean, still, there's so much political problems, so many political problems with that. There shouldn't be. It should be allowed to happen, but still, it's tricky. I think what you're going to see more of is things like, you know, Intesa was talking about buying networks of financial advisors, you know, not going in and buying a whole bank. So, again, in terms of acquisition targets, we're thinking about small private banks in some of the smaller countries. Those will be the cross-border acquisitions, but quite small.
Jackie, I mean, private credit seems to have been in this mix of, you know, the software shock. And so a lot of the companies, especially private equity-owned or private credit fund firms, you know, trouble is not immediately obvious because you don't really what's in the books. Could that impact some of the banks or financial services in your world?
It definitely could, and obviously there's a lot of talk about it. I just don't think anything's going to happen soon. I think on the one hand you've got very difficult reporting of actually who owns what or who's exposed to what. But it's clear that, you know, banks, I think it's like 5 times more capital intensive to lend to SMEs rather than to finance private credit funds. You know, so they're doing a lot of financing there. What gives me a lot of comfort, though, is there's so much liquidity in the market. If you look at the deregulation that's going on in the US, we think it's about $5.8 trillion with a T of balance sheet capacity that's opening up this year just from the leverage ratio changing. So that's a huge amount of cash that can go to work. You know, I don't think there's any problems with financing for this year at least. So, yeah, worry about it, but it's hard to know what to worry about, especially when there's so much liquidity.
But we saw quite a big chunk actually being wiped off credits in the last 2 days. And this is not on valuations, it's just because the business model changes. So I imagine financial companies or banks are looking at what are the things they own.
Yeah, I mean, you'd hope so, and you'd hope, you know, they have significant protections as well. I also think, you know, in terms of this whole private credit funds, it's actually very difficult for there to be any kind of run or blow up there. I mean, it's hard to get your money out. I mean, this is one of the great and the terrible things about private credit, the illiquidity. So, yeah, banks, we know that the supervisors have been all over them on this. They've been getting their own numbers. You know, sometimes I speak to the ECB about this, and they've been on it for the last 2 years. So, you know, and they can get whatever information they want from the banks and put capital charges up if they want to, and they have. So I feel relaxed, at least this year. When there's so much liquidity, it's hard to get concerned for this year.
Jackie, do you make a difference between some of the European, I mean, some of the French banks compared to some of the Italian banks? Like, how does, you know, headquarter matter?
Just in terms of what, valuations or credit quality?
Yeah, just in terms of whether you like the banks. I mean, BNP had a good set of results.
Yeah, that's great. The problem is you can't take BNP out of France. And when you're looking at where these things are trading, every now and again they get to look cheap. There's a government headline. But we'd rather not have that volatility. I mean, we don't really own any French banks in the fund. We have a couple of very small acquisition targets that won't go with the big headlines. So that's how we play it.
Your take on UBS? We were in Zurich yesterday, actually, with the program, because we spoke to Sir Geranmayeh. I mean, it's all about capital requirements and where they end up, whether they can even have an M&A strategy.
Exactly, and it's super if you're a credit analyst and invest in debt. The more capital, the better. So, you know, I understand the problems, though, and I'm a Swiss citizen, so maybe I end up voting on this whole capital thing. I do think it's very tricky. I mean, they've got a 14.5% core equity ratio. They're going to be asked to maybe do another 26 billion Swiss francs of equity. They're going to be way off the charts in terms of, you know, capitalisation. Capital did not help Credit Suisse. It was nothing to do with capital. So, you know, I understand the rationale behind it. You know, I was thinking there would be more of a compromise, and I think in the government there was a suggested compromise, but I think the finance minister, Keller Sutter, said, no dilution with AT1s. So, yeah, I've got a feeling they're just going to have to go with it. The numbers by the end of June, we hope by the end of June they'll have a plan, and they're just going to have to raise a load of equity. I think that's it. Maybe a little bit less than expected, but...
Jackie, thank you so much for joining us. That was Jackie Ineke, the Chief Investment Officer of Spring Investments. Now, Shell said its fourth quarter profit slumped, undershooting expectations as lower crude prices, a weak oil trading performance, and a struggling chemicals business dented earnings. The Chief Executive, Wael Swan, spoke to us earlier this morning.
We are preferentially allocating capital to buybacks because we still see a very attractive buyback in Shell. Our free cash flow yield continues to be very attractive. We see a great runway. We have a line of sight to 10% free cash flow per share growth every year between now and 2030. So being able to buy back Shell, in my mind, is a very, very good investment. To give you a sense, over the last 4 years or so, we've bought back a quarter of the company at an average price that's around 20% lower than where we are today. That doesn't mean that we don't continue to look at opportunities to be able to also invest, and that's what we did last year. $2 billion of our capital budget went into M&A, into what we would call bolt-ons in our deep water space, that contributes to our production growth in 2030 and beyond. So this is a very, very focused allocation of capital in pursuit of long-term shareholder value.
Well, that was Wael Swan, Shell CEO, speaking on Bloomberg's opening trade earlier today. Now, freight rates are under pressure in 2026 as new capacity comes online and as the Red Sea reopens to global shipping. That was among the views expressed by Maersk Chief Executive Vincent Clerc, who discussed the Danish company's outlook also on opening trade. Speaking earlier, Clerc explained why the ranges on their 2026 guidance are so big.
When you look at 2026, is still the big amount of uncertainty that there is around a couple of key fronts. And it all revolves around shipping rates, so the prices that we will be able to take. After a few years following COVID of bumper profits and historically high freight rates, we're seeing a normalization now with big investments in tonnage coming online ahead of supply. And as you mentioned, the Bab el-Mandab Strait reopening. And we expect more and more services to go through the Red Sea again, which will free further capacity, and we expect will create a pricing environment that will be under pressure for the shipping division. So that and the uncertainty that there is around the timing of how this is going to play out means a pretty large range, as you said. The rest of the business, though, continues to progress. Underlying demand for the services that we provide, whether it is in shipping, in terminal, or in logistics, remains strong. There's good opportunities for growth. There's good opportunities also for further margin progression. The one thing that is a big question mark is the freight rate environment, the pricing environment in the shipping.
Okay. And that's going to be determined by, amongst other things, the Red Sea, as you say. What's your level of confidence that the Red Sea is going to continue to reopen? We've got Iran-US talks taking place over the next few days. Huge amounts of tension in the region. We've got a carrier group from the US that's just arrived. What is your level of confidence that that Red Sea story is going to evolve kind of as anticipated right now?
Yeah, so I think let me start with the situation in Gaza, which clearly is making progress. We've seen the reopening of Rafah, and we seem to be moving into the next phase of the reconstruction there. So clearly the temperature has come down, and there has not been any attack for quite a few months now. That's why we have re-announced, after a few trials and a few ships sailing through the Bab el-Mandab Strait, we have announced that we are going to have services now returning permanently through normal sailing routes. The first two with a date on them, the next two have been singled out, and the dates will be communicated shortly. So that will actually put a significant amount of our deployment back through the normal sailing routes. And we do this because we actually believe that the direction of travel, first of all, today is safe, and second, we believe that the chances that this will continue to move in that direction are much higher than the opposite. Now, as you rightfully point out, there is also a new situation playing out between the US and Iran, which we're following very closely, and we're going to act very prudently. If this was to evolve in a negative way, we can undo some of the decisions we have made so far. But overall, after a few years of absence from the Red Sea and sailing through the Suez Canal, we believe that the time has come now. The conditions are in place for a return.
Vincent Clerc there, Maersk Chief Executive Officer, speaking to Guy Johnson on Bloomberg's opening trade. Now, plenty more to come. This is Bloomberg.
Earnings season is here.
Europe's most valuable companies kick off earnings season.
Bloomberg is first to break the numbers.
Some breaking news from First Abu Dhabi Bank.
So Shell, SAP, Total's in the mix there.
You're bringing all the fun today, Guy Johnson.
With the smartest insights.
How are you feeling going into earnings season?
We are still confident that we can deliver to that acceleration of total revenue growth.
Give me a sense of what you're most optimistic about.
I really expect a very strong Q4.
Continuing coverage on Bloomberg.
The conversations that matter, the insights you need. This is a pulse, and I'm Francine Lacqua here in London. Now, the last major arms control agreement between the U.S. and Russia has expired, increasing the risk of a new arms race. The Strategic Arms Reduction Treaty, or START, had limited the size of both countries' nuclear arsenals and allowed for inspections. Now, in September, President Putin said he would stick to its terms if the U.S. did, but President Trump did not respond. And President Trump has also spoken with China's Xi Jinping in a call that covered trade and geopolitical flashpoints, including Taiwan. Now, their conversation comes as they prepare for a summit in April. Trump highlighted new Chinese commitments to buy more U.S. soybeans, energy, and airplane engines, while Xi urged caution on Washington's planned arms sales for Taipei. And finally, speaking with NBC News, Trump framed the call positively.
Is there any doubt in your mind that interest rates are going to be lowered?
Not much.
Why? How can you say that?
I just think they're going to be lowered. I mean, they should.
Is your new Fed pick on board with that?
We're way high.
As the UK economy is in focus today ahead of the Bank of England decision, our next guest takes positive outlook of the UK's prospects. Sir Richard Harpin has amassed one of Britain's biggest fortunes through building up household repair business HomeServe, which was bought by Brookfield Asset Management in 2023. Richard is also founder of UK Family Office Growth Partners and joins us now. Richard, I always look forward to our conversations because you really have a unique viewpoint of what the UK needs to do. So first of all, how can the UK boost entrepreneurship?
I think even today that the UK is a great place for starting a business. I do think that we need to have a government that can get out of the way and let entrepreneurs just grow their businesses. And this is a place where we can, small country, but represents a global opportunity to expand internationally. And that's certainly what I did with HomeServe. Over 30 years, expanding into many countries, and we need more businesses to do that.
Richard, I mean, do you feel uneasy? There's a significant tax hike, right, that's coming in for family business owners from April, for example. Is there anything that just gets you, if not mad, just annoyed at the government for what they're doing?
We still have a low corporation tax rate of 25% for most businesses. We do need to make sure that the costs for businesses don't go up anymore. The business rates increases is not good. The employers' NI increases was a really bad thing to do, but really now we need to just focus on growth. The UK is really good at startups. We had over 350,000 last year. We have, though, only 7,500 large businesses in the UK. So we forget about those medium-sized, a lot of family businesses. There's about 100,000 of them, and we need to turn those into the next large companies.
Richard, there's a number of private equity that's looking for deals here, or private equity money that's looking for a home. I mean, is it something that you're looking at to partner with or do anything with? Because there are opportunities in the UK if done right.
Yeah, private equity is a force for good. I personally set up my own investment business, which is an entrepreneur investing in other entrepreneurs, 100 million of my own capital, another 50 million committed, and that's to try and help businesses to get more capital, to de-risk, and then to grow quicker.
When you look at the next couple of quarters, what are you most excited about? I know look at the markets, and I know at private dinners, people think about UK political risk. They think, look, is Starmer staying because of this unease in the labour markets? Are you having similar conversations, or do you think this is being overblown?
I think it's been overblown. I think it is really about whatever the difficulties in an economy, really important that those mid-sized entrepreneurs, chief execs, founders, just focus on growth. We do have 56 businesses in the UK that have achieved a value of $1 billion or more, where the founder's still involved. There are 94 FTSE 350 chief execs that have added more than $1 billion to their businesses since they took over as chief exec. So we need to do more of that. With my organisation Business Leader, that's about saying, how can we help mid-sized businesses to scale? I look back on my 30-year career at HomeServe and said, there's 9 things I know now that I wish I'd known at the start of my entrepreneurial journey.
Your top 3, what are they?
They are get some investment to grow. Second one would be get a coach or mentor. Most entrepreneurs don't look for that free advice that a mentor could bring. I got one Nigel Morris that helped me to conquer America when the model was wrong, and he helped me to really sort that out. We need more businesses to expand, and then it's really about getting the right team in the business.
But Richard, I mean, when you look at, what's the most common mistake? Is it not enough risk-taking, or is it actually not getting enough advice? Because they the two go hand in hand, right? You have to be bold, but if you're too bold and maybe become big too quickly, then a lot of companies fold because of that.
The biggest issue with entrepreneurs is we're foxes. We're always looking for the next opportunity, and we need to be really focused on a simple business model and then scale it with the right people and avoid those other distractions.
Richard, you have your book, which I love because it's actually in the Pulse colours. It's like you did it for the show because it's exactly the colours. But there's not enough optimism in the UK about entrepreneurship. Who needs to change that? Is it the government, policymakers, entrepreneurships?
I think it's up to entrepreneurs like me and others to celebrate entrepreneurship more. There's a big conference taking place on March the 26th here in London. 750 entrepreneurs running mid-sized businesses. Every week I run a 2-hour workshop helping entrepreneurs avoid all the mistakes that I made and embark upon a Business Leader 9 Steps growth program. So we just need more of that. If I was saying, are there a few things that this government could do to help business? Then number 1 would be let's get more investment to scale. We're doing that with the British Business Bank. Let's do more. Let's sort out apprenticeships. We need many more of those. Checker Trade is a business I invested in. We need another 1 million tradespeople in the UK in the next 10 years.
Well, hopefully someone from the government is listening. Otherwise, we're speaking to Governor Bailey a little bit later on. That was Richard Harpin of HomeServe. This is Bloomberg.